a market guest then to talk a little bit more about the trajectory for our own markets. And right here in our studios, we have Mahesh Patil, CIO at Aditya Birla Sun Life AMC. Mahesh, good to have you in our studios. Morning. And it's been pretty much more of the same, this phase of consolidation that's kicking in. Do you believe that the undertone of the market is still looking bullish and that, yes, there may be speed bumps along the way, but by and large, we're okay?
Yeah, I think, we have seen the momentum clearly has kind of broken down, what we saw earlier. And not only the market, it's more to do with the earnings momentum, right? So, the strong earnings growth, what we saw in the last 3 years until FY24. So, that in the last 2 quarters has kind of slowed down. And for the first time, we have seen downgrades to earnings after the second quarter and the first quarter numbers. So, clearly there is some bit of a slowdown, and that is kind of leading to a kind of a sluggishness, or even as for the matter, we've seen that the market breadth also has weakened quite a bit. Now that's kind of coming back. I would say that the broader trend for the market still looks up, because one would believe that the kind of a slowdown what we are seeing is kind of a temporary cyclical slowdown. To some extent impacted because of the government spending in the first half has been weaker because of elections, and it took time for the ministries to be formed. So I think that is now gaining momentum. The rural recovery also, I think, has been slightly weak, and to some extent the urban demand has weakened because of the higher food inflation. I think some of these things are more cyclical. I think they should normalize in the next 1 or 2 quarters, and I think one should. I think for at least for this fiscal year, I think the earnings trajectory seems to be kind of weaker, and that will kind of weigh down on the market, and you might see the market kind of in a narrow range. But I think broader trend for the market, I think the economy, I think we are still, if not around 6.5–7% growth, we are still likely to do around 6% GDP growth, which is a good number, I would think, in the current context.
Right. A very good morning to you, Mr. Patil. I wanted to understand, you said that there have been earnings downgrade. The Q2 earnings were not that enthusing. Earnings this year will be weaker. What sort of a number are we working out when you talk about the earnings growth now for FY25? And what does that mean actually for FY26 earnings as well? Because now people will have to actually, investors will have to kind of subdue their expectations from the markets, isn't it then?
Yeah, so I think this year to some extent there has been some normalization. Last 3 years we have seen that the margin improvement, which was significantly high, a lot of companies had gains from lower commodity prices. We have seen deleveraging from corporates, so interest costs had come down, and your bottom line growth was kind of running ahead of the top line growth. So this year clearly there is a normalization, and a few sectors, we have seen kind of a disappointments over there, especially on the consumption and the consumer discretionary side. And as a result, I think we would see probably a high single digit growth in this fiscal year, which is significantly lower than, almost like 6% lower than what it was at the beginning of the fiscal year. And some of the sectors, I think, should kind of normalize next year, I would say that. But I think by and large, I think the nominal GDP growth, which is, this year also you are expecting the nominal GDP growth to be around 9 to 10% or so. I think probably earnings will track somewhere around that number. I think next year also, I think, assuming that the nominal GDP growth is slightly above that 10–11% or so, I think we could see growth coming back to the low teens again in the next fiscal year. But I think the overall, I would say that the whole margin improvement and the operating leverage, which was there post-COVID, I think that is clearly behind us. And next year also it will be critical to see how the global economy does, because some of the, while domestic economy should again come back, but I think exports and other areas will depend on how US and the Trump policies play out in the early part of next calendar year.
All right. Hi, Mahesh. This is Shrishti, and wanted to understand your investment philosophy at this point in time, because I believe that you are a follower of GAP, growth at a reasonable price. But given the recent correction, any pockets that are looking interesting to you?
Yeah, so we've seen in the last 6 months, right, there has been a significant stock specific correction in the market, right? So while the market is only down around 7–8% or so from the peak now, there are many stocks which are down like 20–25–30% also, and some of the good quality names which have longer term shown a good steady compounding. And because of the current slowdown or because of the competitive intensity, we have seen correction in some of these names which could be across. So it's not specifically across sectors, I would say, but stocks, good stocks, quality stocks which have underperformed in the last couple of years because of short-term concerns. I think those are the companies which one would look at, and that could be in the consumer discretionary side, in the consumer staples names, or for that matter, even in sectors like, for example, cement, which has kind of seen an earnings cut in this year. But again, looks like this is a kind of a cyclical bottom over here. So yeah, I think good quality names, long-term compounders, which have now corrected. Obviously, you will not get it cheap, but relatively they are better than compared to what it was, say, a couple of years back. Yes.
All right.
Okay, fair enough. Mahesh, I was curious to understand your take as well on the overall liquidity situation, because the FIIs have been hitting the sell button for quite some time right now. It's been a retail-driven domestic rally that we've seen, a liquidity-driven rally that's playing out. What's the sense that you're getting when it comes to the next year?
So this year, yeah, I mean, FIIs last month of October, November have seen a large amount of selling. On the back, on the other side, domestic flows surprisingly have been very good despite the market volatility what we have seen. And I think that even this number for November, which has come in, is also slightly lower, but still shows to be a very steady trend over there. So I think that should continue. I don't see that abating because of the overall confidence in the long term of the market, I think still remains. FIIs, I would believe that we saw some selling recently also on the back of dollar strength, where we saw redemptions in the emerging market funds, and that's the why selling came in India. As we step into the next year, I think a couple of things needs to be watched about in terms of how the global economy does, right, and how the dollar behaves. But I think FIIs are now underweight India, right, after a long period of time. If you look at in the emerging market funds for the first time in the last 10 years, they would be underweight. And I would believe that beyond a point, I don't think they would want to go underweight, because India would still be a better performing market amongst the emerging markets or so. So I would guess that next year, I think in the initial first half, probably because of the policies of Trump and what US does and how then China retaliates, I think will drive the capital flows. But I think after that, I think looking at India's longer term growth story, I think you should see FI. So I think I would say that large amount of selling is behind us. That's what it looks like.
Right, large number of amount of selling is behind us, and you said that FIIs will now look at India's growth story. And interestingly, I wanted to talk about the Aditya Birla Sun Life, what you all have launched, the Aditya Birla Sun Life Conglomerate Fund. Actually, it's a very interesting one. No doubt it's an industry and category first fund that you all have gone ahead with. Could you talk to us more about that? Is this one of the reasons why, given the fact that you have these big businesses in India, how they are growing, how they are shaping the Indian economy, is that one of the reasons why you all have come up with this NFO? If you could speak some more about it.
Yeah, I think so. If you look at in this phase of recovery, what we have seen in the economy, it has been led by investments, and primarily by initially it was the government and the PSUs.
Right.
We think that the private sector now, and especially the large business groups, I think there the animal spirits are now coming back. We see them again coming back and doing large capex. And when you do capex, that drives growth, right, for future top line and earnings growth. And I think some of the large business groups, they have been the in the past large investors. This conglomerate universe, if you look at, they account for almost like 45 to 50% of the capex by the top 1,000 companies, right?
Oh, wow.
In the past. And we think that India is poised where now we are seeing that a lot of the, not only the existing sectors, but all the emerging sectors which are coming up, right, which is whether it's in the electric vehicles, the energy transition, green energy, solar, defense, and semiconductors. All these areas, if you look at the large business groups, they are the large investors in that, so which are the emerging growth sectors. And I think that will create value down the line. So we think that this is a time where the balance sheets, so most of the large groups in the last 3-4 years, right, post-COVID, the strong cash flows which have been there, they have used to delever their balance sheets. So they're sitting on very healthy, pristine balance sheets which they can lever up and invest for future growth. So I think that is kind of a broader narrative, a story which we think which will, as India goes into the next leg of capex growth, they will be drivers for that, and that's where the value creation will happen. Also, I think in the current market context, where we see that where there is some amount of weakness, which is there, the large groups, they are better placed, to manage the slowdown because of the diversity of cash flows what they have from different businesses. I think they have a better control in terms of cash flows which they can use in terms of emerging businesses. And some of these groups have also seen some change in the management or some next generation coming in. And we've seen that there has been a kind of a revitalization in terms of the aggression what we are seeing in these groups. So I think that's a broader theme, and this whole cohort of companies, if you look at in the past, also have delivered better returns. And I think as where India is poised for the next capex recovery, I think they will be the key drivers of this growth.
All right, but Mahesh, if we talk about some of the key activities by ABSL MF in November month, some of the key additions were Zomato, as well as where you have increased your exposure, and Swiggy was actually the new entrant. But given this space, Mahesh, what we hear about the news flow that the competition is also trying to kick in, how do you see the growth opportunities for these companies?
So, I mean, some of these new age companies have seen, especially in this space, have seen a good growth, and they are actually getting into other areas, right? Initially it was food delivery, then it was quick commerce. So the whole addressable market and the time which is there is increasing. Say like some of these, when they came for the IPO, okay, it was only a particular kind of business. So I think that has expanded the opportunity, but I think these businesses, okay, would still remain a bit volatile, because in the new areas, while in the existing business they have established their presence, but in the new areas there will be some competition and you will see some volatility. I think what we look at generally as a template when we evaluate some of these new age technology companies, not talking about any particular company, is whether the company has established a kind of a competitive leadership over there, whether they've got the unit economics in place, and whether they have enough strong balance sheet, okay, to be able to continue and make the investments in that business. So, and if those criteria, the unit economics are in place, then I think, and they have established significant leadership, I think then the ability to manage the competitive intensity is much better.
Right. I just wanted to understand, since we are going to enter a brand new year, everyone would be actually trying to reshuffle their portfolio and try to understand which are the sectors that one should watch out for. So in your view, which are the sectors that one should avoid or not look at in the brand new year? I know it's a tough one given the fact that you have so many new emerging themes that one needs to watch out for, right? So you think the traditional themes will take a backseat?
So I think there is clearly a change in leadership in sectors what we have seen in the last 6 months. Okay, some of the cyclical sectors, okay, which did very well, they are starting to underperform. But as such, I would say that I mean, what was the trend earlier, where we saw a few sectors or few themes doing very well, right? I mean, significantly outperforming the market last year. I think that dispersion is now coming down. So if you look at in this year, we're not seeing any sector doing very well or also underperforming down. So I think that is kind of narrowing down. So what it means is that now I think going forward it will be more stock specific. I think the bigger trends, okay, what we saw are behind us, and I think that's how we will look at stock specific and companies, okay, which are likely to gain market share, okay, where earnings visibility is good. I think one would focus on that. But I think broadly I would say that next year, assuming that some of the global outlook, right, stabilizes, US for example, if we see the growth remaining steady, and if China is also able to stimulate, I think then some of the global cyclicals, okay, could see a comeback, okay, which had underperformed last year.
All right, Mahesh, I wish we could ask you for all those stock recommendations, but I know that that's not going to be possible. Thank you so much for dropping by to our studios and sharing with us your long-term market outlook.
If you like this video, then like, share and subscribe to ET Now.